Disclaimer: this video is for educational purposes only and is not financial advice. Always do your own research before investing.
What if I told you two ETF can both pay 12%, but one can help build wealth while the other can quietly erode it? Today, I'm ranking 15 TSX listed ETF into three simple risk tiers: conservative core holdings, income boosters, and ultra high yield moonshots. There are 5 ETF in every tier. By the end, you will know what each fund is designed to do, the major risk hiding behind the yield, and which portfolio role it may fit. And stay until the end because of the highest yielding fund is definitely not the highest scoring fund. Let's get into it. Tier 1 is your sleep at night allocation. These are low fee, broadly diversified funds holding real Canadian businesses with sustainable payouts. Nobody's getting rich quick here, and that's the point. Let's run through 5 of the best. Current yield is approximately 3.1%. First up, XDIV from iShares. This one screens from Canadian companies with strong balance sheets and steady for growing dividends. Think quality over just chasing the highest number. It holds around 20 names, and at management fee of just 0.11%, it's one of the cheapest dividend ETFs on the TSX. It wouldn't wow you on income, but the combination of quality screening and rock bottom cost make it a strong core holding. Next one is VDY. Currently yielding is approximately 3 to 4%. Vanguard's high dividend yield ETF, and honestly the TSX staple most Canadian already own. It's been around since 2012. Charges around 0.20%. This catch it's heavily concentrated with close to 45% in the big banks and another 25% in energy. Great core holding, but not a diversified portfolio on its own. Next one is XEI. It is iShares' answer to VDY. Currently, yield is approximately 3 to 3.5%, and where it earns its spot is diversification. It also has MER of 0.22%. Instead of concentrating in banks and energy, XEI spread across roughly 75 holdings, adding meaningful weight in utilities, telecoms, and real estate. If you want high dividend exposure without betting your portfolio into sector, XCI is the strong pick. Next one is XIC. It currently yield around 2 to 2.6%. It is close to own the whole Canadian market as you can get in one ticker. Total market exposure, not just dividend payer. The headline number here is the fee, 0.06%, making it one of the cheapest ETF available in Canada. This is your foundation holding, not your income engine. The last one is XFN, the iShares S&P and TSX Capped Financial Index ETF. If there's a one sector that has consistently powered Canadian dividend investing, it is financials. XFN gives you exposure to Canada's largest banks, insurance companies, and financial institutions in a single ETF. With a low management fee of 0.61% and a strong total return record over the past year, XFN is an excellent way to add high quality dividend growth without taking on leverage. While it focuses on one sector, Canada's financial industry has historically been one of the most resilient and shareholder friendly sector in the market, making XFN a strong complement to a diversified core portfolio holdings. So here we go. 5 solid low cost building blocks. None of these will make you rich fast, but total return growth plus dividends compounded over years has quarterly beaten the flashy 20, 30, or even 40% yielders over almost every 5-year stretch. Keep that in mind because we are about to turn the risk dial up a lot in the next video. Tier 2 is where we start using modest leverage, usually around 25% and covered call option writing to meaningfully boost monthly cash flow. You are still holding real diversified underlying stocks, but now there's a more moving parts and definitely more volatility as well. Here are 5 worth knowing. Currently, yield is approximately 9 to 9.8%. Each TIV takes a basket of blue chip Canadian covered call ETFs and layer on about 25% leverage through cash borrowing, not derivatives. And since inception, it's actually outperformed the S&P TSX 60 on a total return basis. It is a risk on yield booster, a small satellite position for someone who already has their core position built. Next one is HYLD, Hamilton Enhanced US Covered Call ETF. Currently with yield of almost 12%, HYLD is HIF's US cousin. Same 25% leverage structure, but wrapping a diversified basket of US equity covered call ETFs instead of Canadian ones. If you want US equity exposure with a much higher income stream than a plain S&P 500 ETF, this is how Hamilton delivers it with the leverage risk that comes attached. Next one is HHLE Harvest Healthcare Leaders Enhanced Income ETF with approximate yield of 13 to 14%. Instead of betting on one pharma name, HHLE gives you an equally weighted basket of 25 large cap global healthcare leaders like Eli Lilly, United Health, Novo Nordic, Johnson& Johnson, with an active covered call strategy and about 25% leverage layered on top. You get that demographic tailwind of an aging population and GLP-1 drug growth, but spread across 25 companies instead of riding one stock's earning reports. Next one is USCL. Currently with a yield of 12 to 13%. USCL gives you a large cap US equity exposure with about a 125% leverage layered on top. Paired with an active cold call writing program across the portfolio, it is more diversified, broad market way to generate double-digit US income than betting on a single stock. Though remember that leverage mean it will also fall harder than the plain S&P 500 in a down year. Next one is QQCL. This is also my favorite because I have a position into this. Currently with a yield of 13 to 14%, rounding out tier 2 is QQCL. For anyone who wants direct NASDAQ exposure in this lineup, it tracks the full NASDAQ 100, 100 of the largest non-financial company listed on the exchange. With about 125% leverage and covered calls written on up to half of the portfolio, one honest flag here, the NASDAQ 100 itself is heavily weighted towards mega cap tech names like Apple, Microsoft, Nvidia, and Amazon. So you are trading single stock risk for concentrated sector risk. It is transparent, it is real index, but it's not exactly diversified away from the tech. So this is where income boosters start to mean read the fine print. Leverage cuts both ways. In a drawdown, these funds fall faster than the index they are built on, which bring us to the tier most of us clicked on this video for. Tier 3 is maximum cash flow and maximum risk. We are talking single stock, leveraged, covered call, ETFs yielding anywhere from 25% to 90%. Before we get into these five, one important flag. Tickers like TSLY and MSTY are used by two completely different fund families. YieldMax runs US listed funds under those exact symbol on the New York Stock Exchange. Harvest runs separate TSX listed Canadian funds. The first one is CNYE, Harvest Coinbase Enhanced Income. Current yield is approximately 70 to 90% depending upon the measurement date. CNYE writes covered call on Coinbase with about 25% leverage layered in. And because Coinbase itself is one of the most volatile large cap stocks out there, this is about as high octane as income investing can get on TSX. Next one is MSTE. This one is very popular with currently approximate yield of 40 to 70%. Following a recent distribution cut, MST gives you leverage cover call exposure to MicroStrategy, now rebranded Strategy Incorporated, which is essentially a leverage bet on Bitcoin through a public company wrapper. MST's distribution was recently cut and the fund has traded down sharply. This is the name to watch closely, not just for the chasing of the headline numbers. Next one is TSLSLY, Harvest Tesla Enhanced High Income Shares. Currently yielding around 30 to 35%. TSLY, again the Harvest, TSX listed version writes covered call on Tesla with modest leverage. Tesla stock has been roller coaster. And Tesla TSLY writes every bit of the volatility, both the option premium upside and the downside when the stock drops. Next one is NPHE, which is the another very famous stocks, and I have a big position into it as well. It is Nvidia Enhanced Income Shares. It currently yields around 20 to 25%. NVHE applies the same playbook as to Nvidia as the TSLY, as discussed above. Last one is PLTE, which cover the Palantir. Again, same style, structure, and risk coverage, and it currently yield around 37 to 42%. So here we are, 3 tiers, 15 ETF, and one simple lesson: yield is not the goal. Sustainable total return is. Tier 1 builds the foundation. Tier 2 can boost monthly income once the foundation is in place. Tier 3 is where the excitement lives, but it is also where position sizing and NAV discipline matter most. Now, I want to hear from you. Are you team green, team yellow, or team red? Comment your tier below. Subscribe to Dividend North for ETF health checks, monthly portfolio updates, and honest covered call ETF research focused on income without ignoring capital preservation. Until next time, keep building income, but always protect the capital producing it. Thank you.